Welcome to Iron Financial. This is the show where we help you forge a stronger portfolio and cut right through that market weakness. I'm your lead analyst. All right, let's get straight to it. Today, we are putting a company under the microscope that has absolutely exploded. We're talking up 125% in just 1 year. And that leaves every investor staring at one critical question. Is this a generational buying opportunity, or is it a catastrophic bubble just waiting to pop? We are talking about Semtech, ticker SMTC. You know, this company was, and I'm not exaggerating, on the brink of total disaster. And now it's right at the heart of the AI revolution. So is this a story of solid steel, or is it just fool's gold? Let's break it down.
Look, everybody and their brother is chattering about the AI gold rush, right? They're just throwing money at the big flashy names, your NVIDIAs of the world. But any smart investor, any seasoned investor knows that the real, lasting fortunes, they're often made by the people selling the picks and shovels. And that's exactly what Semtech is. They're not out there mining for AI gold. No, they are forging the critical components, the steel, if you will, that makes the entire railroad possible. Think about it this way. These new AI data centers are like brand new cities being built from scratch, all for these powerful computer chips. Well, Semtech provides the fiber optic and copper superhighways that connect every single one of those chips. They let them talk to each other at just blinding speeds. You know, without Semtech's technology, this whole AI revolution just grinds to a halt. So this isn't some speculative play. This is a foundational play.
Whoa, hold on a second. Foundational play? The stock is up 125% in the last year alone. To me, that sounds less like a foundation and more like a rocket ship just burning pure market hype for fuel. The real question, the one we have to ask, is whether this company's structure is actually made of solid steel, or is it just a pretty facade that's about to collapse under the crushing weight of insane expectations? I mean, let's be real here. This company was on the ropes not that long ago.
And that is exactly where we need to begin. Before we get all seduced by the promises of what's to come, we have to stress test the foundation. We have to kick the tires. And to do that, we need to crack open the books on the company's very recent and, frankly, very troubled past. So let's pull the data up, and we're not talking about opinions here. We're going straight to the source, their fiscal year 2025 annual report. This isn't speculation. This is what the company itself was legally forced to admit.
Okay, this right here, this is a massive flashing red flag. After they did this huge acquisition of Sierra Wireless, the company's own auditors, we're talking Deloitte here, they flagged a material weakness. Now, in plain English, what does that mean? It means their internal controls were broken. They literally couldn't properly track and manage the changes happening inside their own business. It's like a construction crew trying to build a skyscraper without a coherent blueprint. I mean, it raises incredibly serious questions about whether management could even run the massive company they had just built.
And that broken control system was trying to manage this. This is the number that should keep any serious investor up at night. As of January 2024, their consolidated leverage ratio hit an absolutely astonishing 10.27 to 1. Let me just break that down for you so it really sinks in. For every $1 single of earnings the company generated, it was carrying more than $10 in debt. It's like having a mortgage that's 10 times your annual salary. I mean, just think about that. This put them dangerously, terrifyingly close to violating their debt covenants, which are basically these super strict rules set by their lenders. You can think of them as tripwires. One misstep, one bad quarter, and they could have triggered a default. The banks could have just stepped in and seized control of the whole company. The entire structure was leveraged right to the breaking point. This wasn't just some crack in the foundation, the whole building was threatening to collapse.
So let's just put all the pieces together for a second. Back in fiscal year 2025, you had a company that was basically teetering on the edge of bankruptcy. The debt was suffocating them, their internal controls were officially declared weak, and as you can see in their own 10K filing, the stock was just getting crushed compared to the rest of the semiconductor sector. And if that wasn't enough, you can add to that a glut of inventory they couldn't move, and this deep uncertainty about whether their customers were even going to show up to buy anything. This was not a picture of a healthy company. No. This was a company showing every single sign of critical failure. It was a ship taking on water faster than the crew could bail it out.
Okay, that's the history. And yes, it's a grim picture, no doubt about it, but that was then. What really matters is the heavy lifting that's been done since. A new management team came in and they didn't just patch a few cracks. No, they tore the old, rotting structure down to the studs and they rebuilt it with reinforced steel. The fiscal year 2025 report, that's a historical document now. Let's look at the present, let's look at the hard numbers based on their latest earnings report for the fourth quarter of fiscal 2026. Because this, my friends, is where the story completely flips on its head. Let's start with that terrifying debt load we just talked about. Remember that 10.27x ratio, the one that had the company on life support? Well, look at this. As of the end of Q4, the adjusted net leverage ratio is down to 1.3x. I mean, let that sink in. This is a complete night and day transformation. They went from the absolute brink of insolvency to a fortress-like balance sheet in about a year. They have systematically eliminated the single biggest risk that was hanging over this entire company. The foundation is no longer crumbling, it's solid as a rock.
So, the big question is, how in the world did they pull off this miraculous debt reduction? Well, they started generating an incredible amount of cold, hard cash. In the entirety of fiscal year 2025, that disastrous year we just walked through, they generated about $43 million in free cash flow. Now look at this chart. In the fourth quarter of fiscal 2026 alone, a single 3-month period, they generated nearly $60 million, more in one quarter than in the entire previous year. The cash-generating engine has been completely overhauled and is now running at full throttle. And that is the fuel that allows them to pay down debt, to invest in cutting-edge R&D, and to make strategic acquisitions.
And where's that cash coming from? It's coming from record sales. For the full fiscal year 2026, Semtech hit a massive milestone, $1.05 billion in revenue. Now, this isn't just growth for growth's sake. If you look at the breakdown, you see the business is actually well diversified. But the real powerhouses here are those industrial and infrastructure segments. And hidden inside that $310 million infrastructure slice, that's where you'll find the crown jewel, the real engine of this company's future, the data center business. And that's exactly what we need to drill into next.
All right, the balance sheet looks clean. I'll give you that. But a strong foundation is pretty useless if you don't build anything on top of it. You're pointing to this infrastructure segment like it's the hero of the story, but is this a sustainable trend or just a one-time sugar high from a weird market cycle? We need to see if this engine has enough fuel to actually last for the long haul.
This is the engine room. The data center business grew a staggering 58% year over year, hitting a record $223 million. And no, this isn't some fluke. This is the direct, undeniable result of the AI build-out. As companies are scrambling to build these massive AI clusters, they desperately need the high-speed optical and copper interconnects that Semtech makes. Semtech's components are literally the superhighways that allow all that data to move between chips at lightning speed. And this chart right here brilliantly illustrates that the demand for those highways is absolutely exploding.
And you better believe the company knows exactly what's happening. The CEO, Hong Hu, he said it himself on the last earnings call. He's not just talking about incremental improvements here and there. He is calling this one of the most significant infrastructure investments in a generation. This isn't about selling a few more chips next quarter. No, this is about positioning the entire company to be a fundamental supplier to a multi-year, maybe even a decade-long technological transformation. They are explicitly and strategically tying their fate to the AI revolution.
So how are they capitalizing on this generational trend? Well, their strategy is built on 3 incredibly solid pillars. First, speed. They are right at the forefront, developing the next generation 1.6 and 3.2 terabit interconnects that future AI clusters are going to demand. Second, power. As these data centers get bigger and bigger, their electricity bill becomes a massive problem. So Semtech's solutions, things like active copper cables and linear pluggable optics, these are new technologies specifically designed to move data faster while using significantly less energy. Think of it like creating a much more fuel-efficient engine for the internet itself. And third, and this one is absolutely crucial, vertical integration. They are taking control of their own supply chain. And that brings us to their recent acquisition of a company called HIFU. Now, this was a masterstroke. HIFU makes these tiny, super high-performance lasers that are the absolute heart of fiber optic transceivers. By buying them, Semtech went from just supplying some of the electronics around the laser to owning the light source itself. Now, why does that matter? Well, according to the CEO, this single move increases their potential revenue, their content opportunity as he calls it, in a high-speed module from just single-digit dollars to potentially as much as $80. They're not just getting a slice of the pie anymore, they're capturing a much, much bigger piece of the value chain. And they are absolutely convinced this momentum is just getting started. Now, this isn't my forecast. This is the company's direct guidance to Wall Street. They are telling investors point blank to expect the data center business to grow another 50+% this year. I mean, that is an incredible statement of confidence. It tells you that the design wins are locked in, the customer demand is there, and they are preparing to ramp up production for the next massive wave of the AI build-out.
Okay, so let's bring it all home. Let's bring it all together and render a verdict. Is Semtech a trap or is it a treasure? And for me, this is the number that just shatters the bull case.
a price-to-earnings ratio of 265. Let's be perfectly crystal clear about what this means. It means you are paying $265 for every $1 of the company's current annual earnings. Now, just for some context, the average PE ratio for the S&P 500 is typically around 20, maybe 25. This valuation isn't just high, it is in the stratosphere. It prices in not just the 50% growth they're forecasting for this year, but flawless execution and massive growth for years and years and years to come. There is absolutely zero margin for error here.
I get it. The PE ratio is high. There is absolutely no denying that. But you're paying for future growth, not for past performance. The turnaround is complete. The balance sheet is de-risked and clean. They are a critical supplier for the AI build-out, and they are officially guiding for over 50% growth. That level of explosive growth in such a critical sector justifies a premium valuation. A premium, yes, but 265 is not a premium. It's a fantasy. Look at the hard facts on the bear side. The stock has already soared 125% in a single year. The easy money has already been made, plain and simple. We can't forget that the semiconductor market is notoriously cyclical. It goes up, but it also comes crashing down. And what about execution risk? They still have to integrate this new HIFU acquisition and ramp up production, all while competing with absolute giants like Broadcom and Marvell. Any hiccup, any tiny delay, and a stock with this kind of valuation gets utterly destroyed. You're not buying potential, you're buying perfection that's already priced in.
So it all comes down to this. There is absolutely no question that Semtech's management team has done the heavy lifting. They have forged a brand new company from the ashes of the old one, and it is now built on a solid financial foundation with a powerful growth engine. The bull case rests on the belief that you are buying into a critical infrastructure provider at the very beginning of a generational AI build-out. The bear case argues that you're simply too late to the party. The market has already recognized the turnaround, and at a 265 PE ratio, you're no longer paying for the solid steel of their products, you're paying for the thin air of future hopes and dreams. And the final question you have to answer for yourself is, which one is it?
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.